Loan level price adjustments. What in the flying fuck does that mean? Well, if you follow anyone in the real estate space, then you've heard about these, and you've heard there's bad, 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 very bad, no good, completely awful news coming May 1st. Because yes, it is in fact possible, specifically in this industry, to knock someone out again who is already fully unconscious. Just kidding. Things haven't been that bad for us on the mortgage side of things so far this year. Rates have trended down. Mortgage applications are up 30% week over week. People are calling us with enthusiasm in their voices. They sound excited and hopeful about real estate. So you could actually say we were overdue for another blow at this point. And this one is coming in the form of loan level price adjustments. These are additional fees, and they're built into your interest rate. This is why somebody who has an 800 credit score and is putting 30% down gets a better interest rate than somebody who has a 660 and is putting 3 or 5% down. They would get a higher interest rate because they're considered more of a risk, and there are more loan level price adjustments that apply to them. So what's changing? Because these have always been around. Well, beginning May 1st, the buckets that determine these changes, these price adjustments, these additional fees, they're changing when it comes to credit scores, loan to value ratios, occupancy, and debt to income ratios. So some of these changes will actually be helpful, and they'll decrease the cost of borrowing money for some. For others, not so much. Here's just the major ones that need to be on your radar, top of mind for conversations. The credit score buckets that are changing. This is where the changes could actually be perceived as positive, especially if you have a lower credit score. The penalty for you having a credit score below 680 will actually be less after May 1st. They'll also make price adjustments based more specifically on your score. It used to be that once you hit 740, you were golden. Now there's going to be improvements at 760 and 780. The loan to value changes are kind of a mixed bag. The majority of borrowers have a 680 or higher credit score, and if they're putting 15 to 20% down, I'm not saying that's the majority, but if they're putting 15 to 25% down, the pricing will actually be notably worse in May than it is now. For lesser down payments, it's not so bad. For example, if you're putting 3 to 5% down with a credit score below 680, the interest rate pricing will actually be much better after these changes. Debt to income ratio is where things got really rude. So here's why I think it's so rude. Because debt to income ratio calculations, like income calculations, are subjective. It depends on how good your lender is at their job with what your debt to income ratio is going to be. Because how much credit can they give you for your income? Well, it depends on how good they are doing income calculations. If it's their first day on the job, they're probably not that good at it, and they're going to do the really basic conservative route. Well, that's not going to be okay, because now if your debt to income ratio is higher than 40%, you're getting a worse interest rate. There's other changes too, changes based on occupancy. Things will actually get a little bit better for non-owner occupied, so investment properties and second homes and multifamily properties. The price adjustments are moving in the right direction. To me, it seems like the government's trying to help with affordability. I'm making this assumption because if you are putting a small down payment, like 3 to 5%, and you have a low credit score, all these changes are in your favor. So it could also be taking into account mortgage insurance. If you're not familiar with mortgage insurance, this is required on loans when you put less than 20% down. And different than your hazard or homeowner's insurance, mortgage insurance just protects the bank against you. So your homeowner's policy protects you if there's like burglary or a fire. Mortgage insurance is included. It's a premium that's included in your monthly payment when you put less than 20% down to insure the bank against you if you didn't make your payments. They think that if you have a little less skin in the game by putting a smaller down payment, you're more likely to default on your mortgage. And the mortgage insurance company would pay them off in full, pay off your loan for you if you did so. This is why we sometimes see people get a slightly better interest rate if they're putting 18% down versus 20% down. Because once you hit that 20%, the bank doesn't have mortgage insurance covering their ass. I mean risk. So here's the takeaways with all these changes. If you have a credit score above 720 and are looking to buy a house this year, do it now. I rarely put this kind of pressure on anyone, but identify the house and close before May. So, like I said, it's not in good taste to pressure people like this, but I'm doing it anyway. So take note, look alive. We've seen a shift too in the last 2 weeks where we're moving away from a buyer's market and into a balanced market. All of our clients who made offers over the weekend were in multiple offer situations. I think we're just weeks away from a seller's market again. So in that sense too, it behooves you to move fast if buying is a goal for you this year. I just did a webinar on it this week. If you missed it, I'll put the link below. Also, it's going to be really important, huge takeaway, work with a lender who knows what they're doing on your income calculation. Because this is now going to mean more than just the price range you qualify to shop in, which was pretty big, like how much house you can afford to buy is very dependent on your income calculation. But apparently people don't care because Rocket Mortgage is the number one lender in the country. But now your income calculation is also going to affect the interest rate you're getting. So work with a lender who knows how to do this. Income calc guidelines change based on the type of pay, the type of loan program, the history of your employment, the shade of blue that the sky is today. So if your lender's not well versed on all of these things, they can't maximize their credit they're giving you for every single dollar earned. And then maybe put less money down. It could actually make sense if it pencils to a better interest rate for you. This requires a total cost analysis and is going to be very specific to each person. But honestly, in closing, the news isn't as bad as everyone has made it out to be, including the drama queen at the beginning of this video. But the truth is that to get your guys' attention, sometimes I have to add a little bit of flair.